Now, yesterday, seeing the rally into the close, it's always a great signal. I always like to see the market close higher. But the session was cautious, and there continues to be clear signs of concerns in several areas. Sellers certainly more motivated than buyers. You have more down volume than up volume from the New York and NASDAQ. Moreover, the carnage in those high beta momentum names, mostly traded on NASDAQ, continues to really hurt parts of this rally. And even today, the NASDAQ has been down for most of the session. Hence the flight to safety and more quality exposure there in the equity side. Now, this cautious tone of this session has resulted in safe havens, utilities, real estate significantly outperforming communication services, which is, of course, where you have Google and Facebook. The bottom line, what does this mean for your money? I brought in to discuss Bullseye Brief founder and portfolio manager Adam Johnson and one of our favorites, Kingsview Asset Management CIO. He's a Fox News contributor, Scott Martin. You know, Scott, I had all my notes in an index card and left in my office, but here's the gist of it all.
I don't even have index cards, so there you go.
Well, I also have the folder and then I have the papers, but we'll get into that later. Here's the thing, Scott. You know, when the markets go up 700 points in 2 days, the media reports it as this crazy exuberance, right? But this has been somewhat of a measured rally. And some of the areas that are benefiting are more, cautious in the utilities, real estate, material names. This is not a mindless knee-jerk rally, and I think it's smart money just wanting equity exposure.
I think so. And what I would say, Charles, smart equity exposure that we've talked about, my friend, for some months now. Equity exposure that can take advantage of, let's say, lower interest rates, which at this point, who knows where the bottom is in the 10-year Treasury, but it's probably not even here. So to me, yes, you're right. There's more equity exposure, but it's at least a little bit smarter equity exposure with some dividends attached to it, like you mentioned, with utilities and real estate. And also you mentioned earlier, we did have a good sell-off in tech, though, too, earlier this week. Remember, the session wasn't bad overall, but my goodness, I mean, you look across tech land on Monday, and it was a disaster. It was a minefield. So seeing that we've had a little bit of a reflation in price from that sell-off Monday is certainly constructive as well.
Right, and that bifurcation, Adam, that he talked about with the overall market, right?
Yes.
There's also within that whole momentum crowd, because semiconductors are coming back nicely, software.
Oh, I know, they're in my portfolio.
Okay, great. Yeah. Google, though, getting hit again. I know they're making an acquisition today, but Facebook getting hit again. The government circling the wagons, the sharks are swimming after the sharks. What do you make, though? Because I think the message of the market this week is that you want to be in equities, but you don't necessarily have to be in those names, the household names that always make money.
Yeah, I think that's right. I look at what's making money in my own portfolio, and it's a lot of the names away from the obvious ones. It's not Google and Facebook. I am long Facebook. But it's some of the biotech names. It's some of the other healthcare names. Believe it or not, UNH coming back. I'm also buying oils. I've been taking it on the chin on the oils, but I think there's so much negativity that's really kind of maxed out on Monday that you come in and you start buying the names that are levered to the cyclical parts of the economy.
It's interesting because energy, the best performing sector, and even before that spike that Jeff Flock showed us, energy was doing really well. Maybe the stocks predicting the oil market. Scott, I do want to ask about the relationship with these tariffs, because the market is it's been edgy all day. You can cut the tension with a knife. No one wants to be out of this market right now in case we get word at any moment, perhaps, that there's either a deal with Mexico or they're going to delay those tariffs. If that is the news, what happens to this market?
The market will pop. Now, will it sustain itself? That's anybody's guess, because as we've kind of found out, it's the tariff thing with Mexico looks like that's a passing fancy. The thing with China, certainly more interesting. So, yes, I would tell you, though, going into the end of the week here, there's a lot of headline risk here. I mean, we've got non-farm payrolls tomorrow morning, and then you've got, the weekend tweet risk, let's say, of maybe things being postponed as far as the 5% tariffs kicking in with Mexico on Monday. So any of those two things go the right way, being a decent jobs number, maybe with a little bit of wage growth, plus maybe some tariff resolution with Mexico, actually pops the S&P probably a good 20 points.
Is that the good 1-2 punch? We're looking for good numbers tomorrow. But by the way, the bar is significantly lower after ADP.
ADP was very weak, not a lot of jobs created. If we can get a decent jobs number, and if we can get some sort of inkling of softening with Mexico, and maybe even something with China, because they do want a deal. You read the text of what they wrote last weekend.
You believe China wants a deal?
Oh, yeah, Charles. If you go back and look at the white paper that they released last Saturday, there are words like win-win, compromise, mutual, on and on, constructive discussions. And the U.S. refers to, in its rebuttal, as the conversation as ongoing. They use the present tense. They both want to deal.
They put away the saber rattling that we saw last week. That's away. They're not talking about Mao anymore. They're not referencing war.
Correct.
Yeah.
I think the market's sniffing it out. If you look at the basket of trade-related stocks, and Scott, maybe you're looking at that as well, it started to turn, and the market has generally figured out these turns before they actually happen.
All right, gentlemen, we got to leave it there. Two of my favorites, Adam, Scott, thank you both very, very much.
Thanks, Charles.
See you.